A massive 4.46% plunge in the KOSPI. Today, we are breaking down a severe market shock driven by a violent collision of two forces. We've got sudden doubts surrounding AI capital expenditure and rising oil pressure squeezing tech giants like SK Hynix. In this explainer, we're going to look under the hood of this massive sell-off, identify the exact catalysts, and uncover the hidden order book signals, showing exactly who panic sold and who quietly bought the dip. Let's get right into it. If you felt absolute whiplash on the trading floor today, you are definitely not alone. Our mascot, Loro, is literally wide awake, adrenaline pumping and bracing for impact. And honestly, that is a perfect mirror of every single institutional trader the second the market opened today. This wasn't just a gradual slide, it was a sudden, incredibly aggressive repricing of risk. So here is the core data point that completely defined the session. The KOSP plunged 4.46%, officially closing at 6,516.27. Look, a move of this magnitude in a major national index, it doesn't just happen in a vacuum. It requires a perfect storm of macroeconomic pressure slamming right into sector-specific panic. And that storm hit fast. The index didn't just drift lower. It gapped down 2.6% right out of the gate. Boom. It instantly priced in those heavy U.S. market declines from late last week, compounded by escalating weekend geopolitical tensions. The market was essentially playing catch-up to global fears the absolute second the bell rang. When we look at the sector breakdown, it is an absolute sea of red. Out of 943 constituent stocks, a staggering 799 went down. That is a broad, systemic, risk-off environment, no doubt about it. But the true epicenter of this earthquake, it was hyper-concentrated right in the heavyweight tech and memory semiconductor sectors. So the crucial question is, what actually triggered this specific tech meltdown? Well, the primary catalyst was this sudden, chilling wave of doubt surrounding global AI capital expenditure. And the spark for that doubt came directly from the announcement of Moonshot's new KIMI K3 model. This one single development fundamentally altered the market's entire expectation for future infrastructure spending. Because here is the hardware problem. KIMI K3 reportedly performs competitively with top-tier, closed AI models, but at a mere fraction of the cost. The logic here is pretty brutal. If competitors can reach frontier-level AI so cheaply, hyperscalers are going to really struggle to justify massive spending on premium AI infrastructure. Investors instantly slashed their growth expectations for AI memory demand. And since Samsung Electronics and SK Hynix are the absolute premier suppliers of high-bandwidth memory, they hold the most direct, highly leveraged exposure to this slowdown. And today, that exposure turned into a massive liability. The velocity of the institutional exit was staggering. SK Hynix plummeted 11.53%, and Samsung Electronics dropped 8.77%. Institutions ruthlessly concentrated their panic right here. Get this, they made up nearly 98% of their total net selling in just these two semiconductor giants alone. Absolutely wild. The gravity of this tech sell-off was so intense that it dragged the entire derivatives market right down into the abyss with it. Institutional net selling pushed KOSPI 200 futures down over 5% by late morning. So at exactly 11:21 a.m., the exchange actually had to step in. A sell-side sidecar was activated. If you aren't familiar, that's an emergency market mechanism that mandates a 5-minute halt on all program trading just to stop the algorithmic bleeding. But tech fundamentals were only half the story today. Simultaneously, we had a brutal macroeconomic chain reaction, crushing equity valuations from the top down. It goes like this. Step 1, geopolitical tension erupts. Step 2, a sudden oil price spike. Step 3, higher oil forces bond yields to rise. And step 4, those rising yields mathematically force a drop in broader equity valuations. Let's walk through the exact evidence. Okay, so step 1 began over the weekend. U.S. Central Command launched a series of strikes targeting Iranian capabilities near the Strait of Hormuz. We saw blocked vessels, redirected ships, and a naval blockade taking shape in literally one of the most critical maritime choke points on the planet. This military escalation instantly ignited severe fears of a massive structural disruption to global oil supply chains. And energy markets reacted exactly as the mechanics of supply and demand dictate. WTI crude jumped 2.51% to close at $83.83 a barrel, while Brent crude spiked even harder, rising 3.87% to $88.10. That geopolitical risk premium was being priced in real time. Now, you might be wondering, why does a spike in crude oil matter so much to Korean equity valuations?
Well, because oil prices are a primary, immediate driver of near-term inflation expectations. And when the market expects higher inflation, it demands higher yields on debt. Today, the Korean 10-year government bond yield spiked to 4.35%. In financial modeling, when your risk-free discount rate goes up, the present value of future corporate earnings automatically goes down. That dynamic added an incredibly heavy layer of downward pressure on equity valuations across the entire KOSPI, regardless of the sector.
But hold on, because buried in the order book is a hidden, super counterintuitive signal. Despite the absolute bloodbath on the surface, foreign investors were actually net buyers of Korean equities today. I know, surprising, right? And they concentrated their capital right into the center of the fire, Samsung and SK Hynix. Foreigners net bought over 887 billion won worth of those two specific stocks. They clearly viewed this massive drop as a rare entry opportunity.
So, if foreign capital was buying up the dip, who exactly was dumping the market with such ferocity? Domestic institutions. Securities firms and trust accounts drove an overwhelming 82.3% of all institutional selling. Their combined net selling in Samsung and SK Hynix actually exceeded their total net selling. But why? Why were they liquidating tech so aggressively?
Well, the answer isn't necessarily human panic, it's actually market microstructure. Specifically, leveraged ETF rebalancing. You see, trust accounts manage leveraged ETFs that hold heavy weightings in Samsung and SK Hynix. By design, when the underlying stock falls, a leveraged ETF is mathematically forced to sell additional shares just to maintain its daily leverage ratio. Furthermore, securities firms acting as liquidity providers for these funds must also sell their hedge positions. It creates this mechanized, forced selling loop. Prices drop, the algorithm forces a sell order, which drops the price further, triggering another sell. This mechanical rebalancing massively amplified the volatility we saw today. So, wrapping this all up, today's 4.46% plunge wasn't just a simple panic. It was a highly complex, mechanized interplay. You've got AI cost efficiency threatening hardware demand, geopolitical tensions choking oil pathways, rising discount rates, and algorithmic forced selling accelerating the descent. The absolutely critical question now is, were domestic institutions forced to sell at the absolute bottom, and will the foreign investors who bought the dip be proven right when the dust finally settles? If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.